Chapter 7, Project Finance Cash Flow Waterfalls, DSCR, Milestone-Based Drawdowns, and Covenant-Heavy Structures. Section 1, The Unique Nature of Project Finance. In the world of corporate lending, project finance stands apart as a specialized discipline. Unlike traditional corporate loans, where lenders assess the overall creditworthiness of a borrower, project finance lending is primarily secured against the future cash flows of a single, specific project. These projects are typically large-scale infrastructure or industrial ventures, such as power plants, toll roads, or mining operations. To facilitate this, a special purpose vehicle, or SPV, is established. This is a distinct legal entity created solely to own and operate the project. This structure isolates the project's financial risk from the sponsor's other business interests. Key characteristics of project finance include: first, non-recourse or limited recourse. Repayment is tied exclusively to the project's revenue. Sponsors' assets are generally protected, though limited financial guarantees may be required. The lender's risk is concentrated entirely on the project's viability and performance. Second, long tenor. Loan terms are extensive, often spanning 10 to 20 years, to align with the long operational life of infrastructure and industrial assets. The loan management system must handle long-term amortization schedules and complex interest calculations. Third, high leverage. Debt typically constitutes a significant portion of the total project cost. This high leverage means that even minor disruptions to cash flow can quickly lead to debt service distress. Financial models must be robust, with a strong emphasis on stress testing and sensitivity analysis. Fourth, complex documentation. The legal and contractual framework is intricate, involving concession agreements, engineering, procurement and construction contracts, operations and maintenance agreements, hedging instruments, and intercreditor agreements. The system must be able to track and manage a wide array of interconnected legal documents and their associated obligations. For technology leaders, the key takeaway is that a project finance module cannot be a simple loan with a long tenor. It must be a sophisticated system capable of modeling these complex, interconnected structures. Section 2, Cash Flow Waterfalls, the core control mechanism. The cash flow waterfall is the contractual heart of a project finance deal. It dictates the precise order in which project revenues are allocated to various expenses and stakeholders each payment period. This mechanism is the primary tool for enforcing payment priority and ensuring that critical obligations are met before any profits are distributed. A typical priority of payments in a waterfall structure is designed to protect the senior lenders by ensuring that operational costs and debt service are paid first. The typical order is: first, operating expenses and maintenance. Second, senior debt service, including interest and principal. Third, reserve account funding, such as debt service reserve or maintenance reserve. Fourth, subordinated debt service, if applicable. Fifth, sponsor dividends or equity returns. And finally, excess cash sweep or additional reserves. Each layer must be fully satisfied before funds cascade to the next level. This waterfall structure is not just a theoretical concept. It must be programmatically enforced in the loan management system, with automated checks at each payment date. Section 3, Debt Service Coverage Ratio, the key metric. The Debt Service Coverage Ratio, or DSCR, is the most critical financial metric in project finance. It measures the project's ability to generate sufficient cash flow to meet its debt obligations. The DSCR is calculated as cash available for debt service divided by total debt service. A DSCR of 1.0 means the project generates exactly enough cash to cover debt payments. A DSCR below 1.0 indicates insufficient cash flow, signaling potential default. Lenders typically require a minimum DSCR of 1.2 to 1.3 times, providing a safety buffer. The DSCR is monitored continuously throughout the life of the loan. If it falls below the covenant threshold, it triggers remedial actions such as cash sweep mechanisms, restrictions on dividend payments, or even lender step-in rights. Section 4, Milestone-Based Drawdowns. Unlike traditional term loans where the full amount is disbursed upfront, project finance loans are drawn down in tranches tied to specific construction or operational milestones. This approach protects lenders by ensuring funds are only released as the project progresses and de-risks. Common milestones include financial close and initial mobilization, completion of foundation work, mechanical completion, commercial operations date, and achievement of target DSCR. Each drawdown request must be accompanied by evidence of milestone completion, such as engineer certifications, inspection reports, and updated financial projections. The loan management system must track these milestones, validate supporting documentation, and automate the drawdown approval workflow. Section 5. Covenant-heavy structures. Project finance deals are characterized by extensive covenant packages designed to protect lenders throughout the project lifecycle. These covenants fall into three main categories: financial covenants, such as minimum DSCR and maximum leverage ratio; operational covenants, such as maintaining insurance coverage and adhering to the operations and maintenance plan; and legal and structural covenants, such as restrictions on asset sales and change of control provisions. Covenant monitoring is not a quarterly exercise. It is continuous and automated. The system must flag breaches immediately and trigger predefined remedial actions. This concludes Chapter 7, Project Finance Cash Flow Waterfalls, DSCR, Milestone-Based Drawdowns, and Covenant-Heavy Structures.